past few weeks, Fed Chairman Jerome Powell has denied repeatedly that the US will impose negative rates, stating, "Negative interest rates are probably not an appropriate or useful policy for us here in the United States." Now, for those who need help translating Fed speak, what this means is that negative interest rates are an absolute certainty. And when the Fed entertains and eventually employs such radical monetary policy, well, we'll fully have embraced clown economics. So in this video, let's talk about why the Fed will end up buying stocks and then eventually impose negative interest rates. But before we go on, I want to make sure you're aware that Doc is giving a free webinar today covering the 7 secrets to trading small accounts. And he's joined by some really well-known traders and investors. So definitely consider signing up as Doc goes live at 4 p.m. Eastern Time today. If you can't make the whole thing or can't make it at all, still consider signing up because the replay will be sent afterwards, and there's a ton of prizes being given out. Nothing else, I think it's a good idea to start this half of 2020 sharpening your skills and learning how to create consistent income through trading in this time of uncertainty and just general volatility. If that at all resonates with you, definitely consider signing up for our free Discord as well, where we talk about trading opportunities, strategies, and education, and have these discussions with anyone regardless of their trading experience. So check out both links in the bio below. And now let's begin by talking about the Fed, and as a refresher, what are they actually trying to do? Well, the quick and dirty explanation of their primary goal is to maintain the value and use of the US dollar, and hence maintain a sustainable level of inflation. It's a common misconception that they're trying to save the economy or somehow guide it. Rather, they're trying to save the value of what helps balance the economy, a functional and stable currency. Now, if we look at an economy in a very simple form, we can see that it's split into 2 camps, consumers and businesses. Together, they represent the push and pull of economic activity, and essentially, the faster that we can get dollars to fly back and forth between these 2 sides, the more we see economic activity as a direct contributor to economic growth. But what happens when consumers suddenly stop transacting with businesses? Well, certainly businesses are impacted and forced to close and scale back. And suddenly we're in a recession. And what's true of deep economic recessions is that they tend to drive up savings by both consumers and businesses. A good indicator of just how serious our current recession has become is the US personal savings rate, which hit a record 33% in April, up from 12.7% in March. And yeah, that's a pretty staggering jump, especially when you consider how it far exceeds the previous record of 17.3% from May 1975. So when consumers are uncertain about their job prospects, they're unlikely to be spending money. In this circumstance, where consumers are more inclined to be saving their money than spending it, we get something called deflation. And this is the arch nemesis of the Fed because it disrupts the ability of the US dollar to drive economic growth. And as we covered, the dollar needs to be moving around a lot, changing a lot of hands in order for economic activity to drive economic growth. And so that's why the Fed does not want you to be saving your money. Instead, what they want you to be doing is spending and investing every dollar possible. Not just because it drives the economy, but more importantly because it drives the use of the US dollar itself. This is important because the US dollar is fiat currency, meaning it has no inherent backing. And really, you could argue that the only thing backing it, giving it value, is faith that it will continue to hold that value, to be seen as a valid medium of exchange. Conversely, if the dollar is no longer seen as a viable means of transacting value, well, the spell is suddenly broken and people realize that it never had value to begin with. So to prevent that chain of events from happening, the Fed wants to ensure that you're confident putting dollars anywhere but a savings account. They want you to salivate over the stock market chasing new highs. Don't pay attention to the doomsayers and the alarmists. The NASDAQ is about to hit a new all-time high. And yeah, sure, FOMO is a very powerful force. Greed is a very powerful and persuasive emotion when we see the market taking off without us. And truly, that's what the Fed wants you to feel. What they don't want you to realize is that they've thrown everything, even the kitchen sink, at those financial markets in an effort to prop them up. Spend a moment and think about how insane it is that they're committing mind-numbing amounts of capital into all their risky, speculative asset classes, and how they've essentially given the market a dopamine high while the economy at large burns. They're making stocks, corporate bonds, auto loans, mortgages, and anything close to defaulting seem worth investing in while the economy is on life support. If previously there was any pretense that fiat markets were free markets, that notion is completely out the door now. And with many things that the Fed is involved in, it only gets worse the more you look at it. Already they have exhausted their entire conventional toolbox to make you act like a good little consumer again. Tools such as interest rates to zero, quantitative easing, fiscal bazookas, corporate bailouts, treasury debt and mortgage-backed security purchases, cutting reserve requirements to zero, and every other trick in the book they've used following 2008. And sure, these actions undeniably support asset prices and help markets chase new highs despite dire economic leading and lagging indicators. But let's not ignore the malcontent hidden behind the number go up and money printers go brr memes. By printing trillions of dollars out of nothing, as they have, the Fed has absolutely annihilated the purchasing power of savers while rewarding yield-thirsty investors that take high risks for high returns. What's more true by the day is that safe investments and prudent savings are going extinct as race to the bottom monetary policy pushes people to chase increasingly risky assets. But that's no accident. That's the aim. The Fed simply wants you to buy stocks, not to save money. But the thing is, the market is cantankerous and will definitely implode if the Fed stops backing it. And investors definitely know this and will exploit it as mutually assured destruction. Now that the box has been opened, there's no closing it. We will soon reach the day that the market's dopamine stimulus inevitably wears off and asset prices rapidly fall, prompting the Fed to resort to more drastic and unprecedented measures as their conventional toolbox is already run dry. In their first act of true desperation, they'll aim to both entice new investors to buy stocks and to also signal continued support of the market by actually buying into the stock market. And yeah, sure, the Fed buying stocks seems a bit extreme, but it's also not unprecedented. Other central banks have engaged in this practice before. And what's been the result of this? Well, buying ETFs has failed to support stock prices, even if it will absolutely send prices through the roof initially. And this should be no surprise because investors and trading algorithms are hooked on cheap money and will always beg for more, pumping the markets higher, but that's all. The markets will then plunge again, submitting to economic gravity. This also highlights how, if buying ETFs is the last hope for the Fed to keep stock prices high, I think it's crazy to think that the stock market will perform well in the distant future. After all, hope is an absurd reason to invest in anything, especially when it concerns the complexities of economic recovery. And furthermore, it really shouldn't surprise anyone that artificially inflated stock prices can't fend off economic stagflation. But here's the thing. The Fed knows that. They know that the ETF purchases will fail to support asset prices, but they'll still do it anyways. They've used up all the effective monetary policies and now they have to resort to the symbolic moves. So when the Fed faces the reality that buying stocks fails to hold up prices, as it inevitably will, their next move that no one will see coming will be to impose negative interest rates, the final frontier of flawed economic policy. And of course, just like buying ETFs, we already know how this will play out based on other central banks. No matter how the Fed tries to sell it as a net benefit, the evidence conclusively shows that going below the zero bound actually has adverse effects. Countries like Germany, Switzerland, and Japan have reached sub-zero levels with no real benefit. Negative interest rates, just like ETF purchases, have little bearing on true economic activity, especially with consumers in the short term where that activity is needed the most for economic recovery. But even still, we'll again go through the same farcical parody. The market will rally on hope until everyone figures out that negative interest rates destroy future growth rather than magically solve systemic issues. So yes, the Fed and the Fed's actions are a monument to the failures of fiat, but thankfully they're not the sole deciding factor in recovery. So one other point to consider is that regardless of the stock market's direction in the days ahead, it's clear to me that fiat markets have crossed a line of no return. Modern monetary theory has entered a new era where corporations and governments are joined at the hip. The revolving door between corporate special interests and politicians will ensure that regardless of how risky corporations act, governments will always be there to bail them out. Underscoring this is the Fed's new role as the biggest whale of all time, given their ability to dictate the market based on their unlimited reserves. With such rampant disregard for sound money principles and with currencies increasingly weaponized in order to stay relevant, I think the stage is now set for a systemic overhaul. Will we embrace it? So as always, thank you so much for watching the video. I know it's been a little bit of time since I put out one, but I'm excited to get back in the saddle, start making some good videos again. Once again, don't forget to catch Doc's webinar today at 4 p.m. And I look forward to talking to you on our Discord once this video's up. So thanks so much for watching. I'll see you guys in the next one. Cheers.